Krishna Kumar joins us now, represents mutual fund. KK, good morning. Thank you for joining us. Are you breathing a sigh of relief that finally mid and small cap stocks have stopped falling? They're not rising like a phoenix, but yeah, they've stopped falling.
I think clearly the mood is a lot better. The domestic risk on the election outcome is behind us at this point in time. NDA is back with the thumping majority, and people expect continuity in policy and acceleration of some of the reform measures the government had been doing and would continue to do. So I think with the kind of valuation comfort that you've seen in mid and small caps, 15-20% discount to large caps at this point in time, I think there is a lot of interest to look into mid caps and small caps with a 2-year perspective. Yeah.
Coming back, KK, have you seen evidence of any change in terms of inflows, SIP, or one time after the mandate?
I think we have continued to see improvement in SIP. That is an ongoing exercise by the industry, which is bearing fruit. On the other side, if you look at lump sum sales, given the sharp move in markets, I think people are evaluating, a better time, basically, because of the rally that you've seen in the last week or so in mid and small caps and large caps also. I think people are evaluating for a better entry point is what I see. So we don't see major move in terms of lump sum sales at this point in time. Too early. We'll await more flows probably into the next month when things are a lot more clear on what the government is doing on some of the issues that people expect a resolution, be it RBI reserves or be it some stimulus from fiscal perspective. I think people will wait to see the measures, the composition of ministry, the cabinet, and also finance ministry is something very important, and we would look forward to see who's probably getting in there.
Okay, so talking about the finance ministry, talking about some of the expectations you have on hopefully perhaps a cut on GST rates and something to boost demand essentially. KK, what are the kind of sectors or pockets of the market that you would expect to see an immediate and lasting impact on? Where would your focus be going forward from here?
Sure. I think we do expect the RBI to improve the liquidity and move to a more surplus liquidity situation given the lower interest rate, lower inflation in the economy, and also I think the rate transmission has been pretty muted. So we would expect that to happen, and along with that, some confidence boosting measures from RBI and government on the overhang on the NBFC and housing developer financing space, that would kind of boost confidence, and there'll be a risk off. So you will have credit spreads also coming off for the corporate borrowers. I think that's something we want to play. I think so. The NBFC trade, which has been kind of washed away in the last 6 months, I think we would see that if this happens, NBFCs, the big ones, the strong ones, would see a fairly good benefit, and also given the consolidation in market shares, again there could be a good interest in NBFCs given the valuations at which they are currently. We also expect the RBI to transfer reserves to the government, and that could be partly utilized for a fiscal stimulus and partly for also recapping PSU banks. So, PSU banks will have to start firing on credit, to help the economy basically at this point in time. But I think the overhang from a merger or consolidation on PSU banks is still there, and so we would await clarity before we play PSU banks in a big way. However, we would like to play, the domestic cyclical recovery as we've been talking about, looking at the industrials, the infra, EPC construction companies, the light engineering companies, which are more on the manufacturing side. I think we do see that government also giving a fillip to manufacturing and exports as one of the long-term measures for India. So I think that would be something very interesting from the industrials, infra, engineering perspective, along with cement, which is a big beneficiary of any uptick in the economy.
Added cement as your big position, because last time when we spoke to Sunil, he was of the view that auto is not the place where you want to be in terms of an overweight positioning. So have you split autos into cement?
Cement has been a fairly strong overweight position across the fund house, basically, compared to a broad index. I think we are significantly overweight. So that's been helping, and we do believe the tightness in the industry and the pricing power that the companies could have will help over the next couple of years. Auto is something that we've been a little cautious given the slowdown that we have seen in the last 6 months. But our view is that over the next 6 months is the time to accumulate some of these stocks and move to a better position on auto components, given the fact that valuations are definitely far more compelling than where they were from a longer term basis. And we do believe that some of the measures from RBI and government would help revive some amount of flows and liquidity into the NBFC space and confidence for the consumer. So I think we would continue to slowly increase exposure to auto component, though selectively at this point in time.
KK wanted to understand what really is the large view at Sundaram. Are you betting big now on a mid-cap recovery, and if someone were to take in a fresh SIP, would you say that allocate a larger sum to maybe mid and small cap funds as opposed to large cap schemes?
See, I think over the last 2 years, if you look at the kind of flows that industry had and also the risk aversion, investors are, I think, underinvested in the mid and small cap space in their asset allocation overall. Given that, and also the fact that valuations are far more reasonable at this point in time and at a discount to large cap indices at this point in time, we would believe that investors would be advised to look incrementally to more mid and small caps, so that they also can rebalance their overall portfolios to a 55-45, 60-40 kind of allocation to large cap vis-a-vis mid cap kind of a position.
Where do you think consumers are headed? They are expensive and they are slowing down. That's the worst combination for any sector to have: expensive and slow down.
Yeah, I would split it into staples, FMCG, where there is a bit of slackening growth and also some pricing, some margin pressures, along with the fact valuations are definitely quite high. So we've been underweight there broadly. The consumer discretionary, the cyclicals part, which is more on the durables, the retail, branded apparel, autos. That space, has seen some amount of correction over the last 1 year. Things are bottoming out in terms of growth there. It's not been a big drag. We would think that the long-term India consumption story on the discretionary side will play out, as more and more people move up the value chain, and look for more durables and branded apparel and, auto, personal transportation. So I think that's the space we would, though there could be some short-term, consolidation, but we would like to build positions for the next couple of years there.
Okay. KK, given the kind of we're seeing a tentative scenario globally right now, and so the question mark around perhaps foreign flows, on the back of whether we're going to see a rush to safe haven buying, or whether or not we're actually going to see that avalanche back into emerging markets. And the domestic story, of course, continues to be strong, all eyes on reforms. Given the current scenario, what's a reasonable return expectation now going forward?
Yeah. So I think one should keep in mind that we also had a little bit of an uptick in the last 1 month, and we are at near new all-time highs in the markets. But overall, the stocks are still far away from all-time highs and even their annual highs. So there is a lot of return potential across the broader markets at this point in time. So we believe that 15% kind of a compounded annual return over the next 3 years or something, investors can look forward to, given that valuations are more comfortable at this point in time and growth is kind of expected to come back strongly over the next couple of years.
Krishna, also wanted to address what's going on with consumption. I mean, what started with autos trickled to FMCG, and now you're even seeing a United Spirits just in their quarterly numbers also see a bit of a volume dip. How soon do you think when it comes to staples can we recover from this slump?
I think staples, will settle down to a lower, growth trend basically. But the quarter that went by and part of the first quarter that we are in has seen some disruption from dry days and also electioneering, etc. So to some extent, I think there will be some little bit of disruption on growth numbers that you would see. But overall, I think segments within FMCG staples like food and liquor, etc., sin products, so would continue to enjoy a little elevated growth rate given the lower levels of penetration and also people uptrade on these products as the income levels get better. So within the FMCG staples, we are a lot more constructive on food and food beverages and liquor.
How much more for corporate banks to go? Suddenly everyone is enamored with corporate banks. Everyone thinks that corporate banks can go one way. I mean, may I politely remind everybody that corporate banks have also a legacy issue of NPAs which will not come back in a hurry, and also if the underlying demand in the economy is strong, growth for corporate banks could be very middling.
I think the big picture remains that the stress recognition is nearly behind you. The resolution is happening, and that would help. And the provisioning has been done aggressively. So to a large extent, the P&L of the banks, the corporate banks would look a lot more healthier. And also the PSU banks have been slow on credit, and NBFCs have been disrupted a little bit in the last 6 months. So that provides a lot of opportunity for the private corporate banks to grow faster. And one of the things that we need to see underneath the growth is that most of them have moved to a 50-60% rural MSME, and so to a large extent they are no longer pure corporate banks. Just take the large ones, ICICI, Axis. I think they all moved into a more of a retail kind of orientation, though they have corporate book at about 30-40%. So I think the bigger picture remains that they would continue to grow, and the full benefit of this post-tax, because provisioning is going to be a little lower going forward sequentially every quarter. Having said that, I think they had enjoyed a great rally. Valuations are catching up. So I think the kind of returns that you saw in them in the last 1 year is not going to be repeated. It's more going to be reflecting a compounding growth of 15-20% that you should expect there.
Okay, because you have a question?
No, I just, what are the chances that India will win the World Cup? Not as an Indian supporter, realistic. As like you fundamentally analyze companies, I'm sure everybody's analyzed the fundamentals of the Indian cricket team, right?
Yeah, I think we continue to be hoping that India will win the World Cup again this time, and I think great team, and they're in fine form, and we have good experience in youth, the team, so we should bring back the trophy.
Like, we are hoping and we are praying that earnings will come. It never comes. I hope it is not that kind of an optimism when it comes to Cricket World Cup.
Well, it's not like it's never happened. We won it twice.
Yeah, but I mean, is there potential for earnings recovery? Yes. Is there potential for India to welcome World Cup? Yes. But is there certainty? The answer to that I don't know. It's like earnings, like I said.
KK is still not willing to stick his neck out and lay a wager.
Yeah, I think earnings are finally, are looking up, right? I think we did have a bad patch of 3 to 4 years, but I think things are getting a lot better at this point in time.
All right, so that's on earnings.